Chapter 10 is Peter Lynch's clear, no-nonsense sermon about what ultimately moves stock prices, earnings, and assets. If you notice a business, say Sensormatic, the inventor of the anti-shoplifting tag, and wonder whether its stock will keep climbing, Lynch's answer is straightforward. Ask how much that company will earn and how those earnings are likely to change over time. A share of stock is not a lottery ticket. It is partial ownership of a business whose long-term value depends on the cash it produces and the assets it owns. Lynch opens with a friendly analogy that makes the point memorable. If you evaluated yourself as a business, your possessions minus your debts would be your book value, and your ability to earn money in the future would be your earnings power. In the same way, a company's book value and its capacity to generate earnings determine what investors will pay for a share today and tomorrow. One of the chapter's central messages is that, over the long run, stock prices follow earnings. Lynch illustrates this using many examples. Companies with steadily rising earnings, like Masco, which he praises for decades of growth, have seen their prices climb in step with profits. Conversely, when earnings stumble, even great name stocks can collapse. Avon and Polaroid are classic cautionary tales. Both were wildly popular at market peaks, but suffered spectacular declines when their earnings failed to match sky-high expectations. Because earnings matter so much, Lynch emphasizes that investors should know what drives a company's earnings and whether those drivers are sustainable. There are 5 basic ways a company increases earnings: reduce costs, raise prices, expand into new markets, sell more of the same product in existing markets, or trim or exit losing operations. When you find a company you like, your homework is to identify which of these levers management is using and to check periodically whether the plan is actually producing results. That naturally brings us to the price-earnings ratio, the familiar shorthand that summarizes how much investors are paying for $1 of current earnings. Lynch explains the price-earnings ratio, often said as PE, in practical terms. A price-earnings ratio of 10 implies that current earnings will earn back your initial purchase in 10 years if earnings remain unchanged. A price-earnings ratio of 40 means 40 years. That is why extremely high price-earnings ratios are risky. The company must grow earnings a great deal to justify the purchase price,